stagflation is a period of very, very slow growth and high inflation. And it was an extended period of slow growth and very high inflation. So I don't think it's fair to say that we are in a period of stagflation right now. It's very likely that the US economy would stall for a quarter or two. It doesn't mean a recession. We've been expecting that the Federal Reserve will raise the federal funds rate by another 50 basis points in September.
Hello everyone, welcome to SFC Markets Finance. As heading into September, the Fed will hike rates again. How many basis points will the Fed hike? How will more hawkish Fed influence Asian countries? Will recession happen next year? Let's welcome Steve Cochrane, Moody's Analytics Chief APAC Economist, to join our discussion. Hello Steve, glad to see you. First of all, how do you comment on Powell's speech in Jackson Hole? Did he send the right message?
Well, he sent a clear message, I think is the best way to say it. He was very clear in his hawkish tone that really the Federal Reserve was ready to do whatever they had to do to bring inflation back under control. There seemed to be many comments that implied that they looked back at history. They've seen how difficult it can be to control inflation once it sets in, particularly once inflation expectations begin to rise. And he seemed very clearly intended to drive policy to whatever it takes to bring inflation back down.
July CPI and the PCE show the U.S. inflation may have peaked, but Powell said the Fed's focus is broader than a month or two of data. Will the Fed misjudge inflation again?
Well, I think it's fair to say that they have their eye on inflation right now very, very closely. So I think I think it's safe to say that they won't misread inflation. They'll be watching it very carefully. They're looking at many broad measures of inflation. So, for example, they are looking at top-line inflation that actually has come in a little bit, but that's largely due to factors that are out of their control, largely due to a turnaround in energy prices and gasoline prices in the U.S. But it will take much more than that to bring inflation down to the Federal Reserve's target rate. So they're looking very broadly. They're looking at all the measures of inflation. And again, I don't think they're going to let anything slip by.
Do you think inflation is a question about supply chain issues or is caused by the excess growth and the money supply?
I think clearly it's both still. The supply chain issues are easing now. I think that's clear, particularly around the Asian economies and around the China economy. We can see that the supply chain indicators of supply chain stress have come in terms of wait times at ports and in terms of shipping costs and shipping times. So that's a very good sign, but they're still not back to normal yet. And there are still risks of some volatility that could raise those supply chain issues once again. But in the US, domestic demand is very strong. And we do see that wage rates are rising pretty quickly at the moment. The labor market is tight. The unemployment rate is at 3.5%. So labor does have a strong hand in terms of bargaining for higher wages. And that does present the risk that at some point one could get into a wage price spiral, again, much like what became out of control back in the 1970s. And so this is one of the risks that the Federal Reserve is watching, to make sure that inflation expectations, particularly amongst consumers, stays well anchored, so that even if, say, wage rates are rising pretty quickly, they don't immediately go out and spend all that and not worry about rising prices, because they'll get another wage hike and they spend again and so forth. The Fed will be watching that very, very closely.
It seems there's still some uncertainty on inflation. So what's your predictions of US inflation?
Well, our forecast now is that we may be back to something close to the Federal Reserve's target, perhaps in 2024. It won't be next year. Right now, if you use CPI, the Consumer Price Inflation Index, as the measure, inflation is at about 8.5% year over year. We expect that by the end of this year, it might be down to 7%. It does seem like inflation has peaked, but it will edge down slowly initially. And then by the end of 2023, we may be getting close to 2%. In our forecast, we have it at about 2.3% at the end of 2023. That means 2024 is the critical year when the Fed's going to be watching to make sure that inflation, if indeed it follows this path, that inflation stays low once it gets down to the target rate.
Paul mentioned that the Fed will learn lessons from Paul Volcker's era. Do you think we are in a period similar to late 1970s and early 1980s? Why?
So the late 1970s and 1980s was a period that we called stagflation. Stagflation is a period of very, very slow growth and high inflation. And it was an extended period of slow growth and very high inflation. So I don't think it's fair to say that we are in a period of stagflation right now, partly because it looks like inflation may be peaking, at least that inflation that was caused by high energy costs, and partly because otherwise, many economies around the world are still in a fairly good condition. I mentioned the United States, where the labor market is very strong, job growth is strong, layoffs are still low, wage rates are rising, and so forth. In Asia, it's not, our economy here in the Asia region is not quite that strong, but still consumers are spending, travel and tourism is up, and inflation is uneven across Asia. It's not extremely high everywhere. And again, I do expect that will come down by, say, the fourth quarter. So I think it's fair to say that we're not so far in an extended period of inflation. We're certainly not in a period of extended weak economic growth.
How can the Fed avoid Volcker-like outcome?
Well, the Fed has a difficult job. The Volcker period, in a sense, serves as an example of the tough policy that is required to tame inflation. Every period is unique as well, and we have risks today that didn't exist then. Then there were high oil and energy prices, although the economy also wasn't coming out of a pandemic where the shape of labor markets changed, labor force participation had changed and such. So there are unique conditions of this business cycle that make it difficult for the Fed to really know completely that they're on the right path, and nobody will know until we get this behind us.
Paul also warns of some pain ahead as the Fed fights to bring down inflation. Does this mean the U.S. economy will not have a soft landing?
Well, I'm not so sure one can separate a soft landing from pain, if you will. A soft landing will probably mean there will be some pain, because indeed it means a slowing down of the economy. And it means as the economy slows down, the unemployment rate could rise, and so it may be somewhat painful for some. And then it would be more painful if the Federal Reserve actually had to raise rates higher than maybe what we're expecting now, if indeed inflation didn't begin to come in as quickly as we would expect. So, for example, we expect that the so-called terminal rate for the federal funds rate, that would be the rate where the Federal Reserve would stop and just hold for a while, will be about 3.5%. But given the hawkish tone of Chairman Powell, and the uncertainty of inflation, it's not difficult to envision an economy in which they took the Federal Reserve rate up to 4%. And we've actually put that into our macroeconomic model to see what that might do with the U.S. economy. At 4%, it's very likely that the U.S. economy would stall for a quarter or two. It doesn't mean a recession, but it does mean that it would get to a point where there'd be little to no growth for a quarter or two. And the unemployment rate could rise to something like 5% from the current 3.5%. That would be measurable. It would be felt. People would see that the labor market is a bit weaker. Wage hikes likely would slow down considerably. So one could say that would be painful, but it wouldn't be a recession. I guess that's the good side of it. That would be a soft landing.
How do you think about the U.S. economy in the fourth quarter?
Well, the economy, I think, is certainly going to slow. The rising of interest rates is definitely going to slow down the pace of investment spending, and likely will probably drive consumers to be more cautious in terms of their own spending. So I think things will definitely slow. The economy will continue to grow, but it will be slower through the end of this year.
Will recession occur next year?
Well, that's the question everybody's asking. And indeed, as the economy is slowing, and then that question will be asked over and over and over again, like when will we hit bottom? I think the good thing to say about the U.S. economy is that it is fairly well balanced, or maybe a better way of saying that is that there are not too many imbalances in the U.S. economy right now. That the financial sector, the banking system is fairly well capitalized. Households generally have a pretty good level of savings still, even though they've been spending out of their savings. And the federal government is supportive in terms of fiscal policy at the moment. And so even if the economy slows, there aren't a lot of trigger points that could cause a recession, not a lot of places where a surprise might emerge that we don't expect. But certainly as the economy slows, the risk of recession will rise. And I think it's safe to say, if we go out, say, the next 12 to 18 months, that the odds of recession might be about even in terms, 50-50, whether the US falls into recession. Part of that will depend on how the rest of the global economy fares. I think the probability of recession in Europe actually is higher. And if Europe were to suffer particularly a deep recession, say during the winter months coming, as energy prices may rise given the shortage of energy supplies in Europe right now, and if that were to extend well into next year, that could hurt the U.S. economy, of course, through trade and investment as well.
Paul emphasized that high interest rate will persist for some time. Do you worry that the Fed will over-tighten?
Well, there is that risk, simply because all of the messaging coming out of the Fed seems to indicate that they'd rather risk on being on the high side of interest rates rather than the low side, that they don't want to risk that they won't be able to contain inflation, that this is such an important factor in managing long-run growth for not only the U.S. economy, but any economy around the world. So sure, there is some risk that there could be some over-tightening. And indeed, that's why we've been looking at various alternatives in terms of whether the Federal Reserve terminates the process at 3.5%. Financial markets are pricing in about a 3.8% terminal rate. That's not far from, say, 4%. If it were 4.5%, well, we're not projecting that, but it's not hard to imagine that if inflation were not contained, that the Federal Reserve would, could at some point continue to hike.
How many basis points will the Fed hike in September meeting?
Yeah. So we've been expecting that the Federal Reserve will raise the federal funds rate by another 50 basis points in September. It seems consistent with the path they've been taking the last since the beginning of this year, and consistent with their previous messaging. Now the word coming out of Jackson Hole is a bit more hawkish, so it does raise the probability that the Fed could do a 75 basis point hike in September. We still have a 50 basis point hike in our forecast, but it wouldn't surprise me if they did 75 basis points, simply again to kind of reinforce the message that Chairman Powell gave at the Jackson Hole conference. And then from there, they might ease. They might do another 25 basis points in November, maybe another 25 in December. And that would actually get them close to that potential terminal rate of about 3.5%, where they might hold steady for quite some time.
As the Fed turns more hawkish, how will Asian countries be affected?
So for Asian central banks, in many ways, this doesn't change the path of policy normalization for most Asian central banks, because many had been raising rates already. In fact, the central bank in South Korea was ahead of the Federal Reserve in terms of raising rates because of very high inflation in Korea. And now just about every central bank in Asia, with the exception of China, which is countercyclical at the moment, and Japan, which is just holding steady, which they have done for many years now, the rest of the region is raising rates. It just means that if the Federal Reserve holds rates at a high level through, say, the course of 2023, that the central banks in Asia may end up holding their rates a little bit higher, particularly if there's an interest in managing foreign exchange rates, for example, managing the spread between local interest rates and the Federal Reserve's, the federal funds rate. It does make policy making a little more difficult for the Chinese central bank, because the PBOC is easing up on interest rates, trying to provide some stimulus to the economy. And so if they're going one way and the Federal Reserve goes another, that does pose some risk to the exchange rate in China, and it could provide some element of importing inflation into China. And China so far has been very fortunate not to experience the higher inflation rates that has been seen elsewhere in Asia.
You talked about the imported inflation is a challenge for all Asian countries. What should Asian countries do to avoid potential risks?
Well, I think there's a couple of things that the Asian countries can do. First of all, it's important that fiscal policy, in other words, government spending, not be pulled back too quickly. It is very logical, given the very supportive fiscal policies of 2020, 2021 into this year, that governments have to start managing their debt, bringing their annual deficits down. But I think it's important that they not react too quickly, not bring them down too quickly, and that spending that governments do engage in is very targeted, if you will, towards aspects of economic recovery, economic stability, and in a sense, preparing for the next upcycle, the next business cycle. So investing in education, I think, is very, very important. Making sure that there is a lot of liquidity in the ample liquidity, if you will, for small businesses, because so many small businesses stopped operating during the pandemic recession, have struggled to come back. And it's very important to give those small businesses an opportunity to get back on their feet. Also, investment in public health, because COVID-19, as we know, is still with us. And if COVID-19 is going to be treated as an endemic disease, and there has to be ample public health capacity to manage any caseload that might rise going forward, so that governments don't have to shut down the economies again.
Some people worry that the 1997 financial crisis will take place again in Asia. What's your opinion?
Yeah, I don't really think that's the case. I think the Asian economy is really a very different place than where it was in 1997. First of all the central banks are very independent now from other policymakers. That's very good in terms of their ability to execute on monetary policy. Second, the banking system has been well supervised. It's fairly well capitalized across the region, and so I think the banking system can withstand any kind of pressure over the next year or so as the economy does slow. And third, the region has done very, very well over the last few years, even during the early years post-pandemic, in terms of thriving on their export-based economies. Each country within APAC has its own specialty. They've all done pretty well, which means that foreign exchange reserves are fairly ample across the region, and current account balances are, if they're not positive, if they're negative, they're much smaller than back during the Asian financial crisis. So largely speaking, policymaking is in better condition. The financial system is in good shape, and the structure of the economies bode well for the outlook.
We have 4 more months left in 2022. How will you comment on Asian economy this year?
Well, I think they're clearly going to slow, much like the rest of the world. I think it's inevitable, given that central banks in this part of the world are raising interest rates. And inflation is still a problem here. Particularly food inflation is very high. I do expect that energy costs, as they have fallen in the United States, will begin to fall here, given that global crude oil prices have come down from their peaks. But those high energy prices are still working through to food and transport costs and such. And my guess is we won't see much improvement on that, maybe until the fourth quarter. We might see some improvement in terms of these broader measures of inflation in the fourth quarter. But high inflation will weigh on consumer spending, and that will work to slow the economy a little bit. But we have to remember that much of the Asian economy, the domestic economies, are still beginning to open up. If you think, a very good example is in the Philippines, where schools had been closed for well over 2 years, and they've just begun to reopen, which means that the children will be back in school. The parents who maybe were not working can finally go back to work and help stimulate the economy. We've seen that happen over and over again throughout the region.
Will debt crisis happen in some Asian countries?
So I don't think there's a really a high chance for a debt crisis. Debt to GDP certainly what became elevated during the pandemic, but not to such a degree that it should lead to a debt crisis in much of Asia. There are some small Asian countries that are facing some difficulties in terms of not having enough foreign exchange reserves, can't afford the import bill that they may face. The big example, of course, is Sri Lanka, but Sri Lanka has many issues in terms of some mistakes in governance. Cambodia, Laos, they're facing some risk right now in terms of foreign exchange reserves and being able to manage the value of their currencies. So there is a bit of risk in those countries. Likely can still be contained. So I don't see the risk as being particularly large here in Asia.
All right. Thank you, Steve. See you next time. Although the Fed becomes more hawkish, Asian countries still have some tools to apply. That's all for today's show. See you.